A new 13F filing just revealed that Warren Buffett's Berkshire Hathaway has bought a position in Alphabet, the parent company of Google. This is shocking to many as he's not typically a tech investor, and according to CNBC, this is his largest tech investment since Apple. Ironically, the more interesting news may be what he sold. In the quarter, Buffett trimmed his Apple position again, this time a 15% reduction, which in terms of dollar amounts is far more significant than the Alphabet stock purchase. The new Google stake is number 10 in their public stock portfolio, which of course is only a small portion of the conglomerate that is Berkshire Hathaway. Today, I'll give you my updated analysis on Alphabet stock, why it was one of my biggest buys in early 2025, and why I think it was probably a good position to add if you're Berkshire Hathaway. Plus, I'll share why I actually agree with the trimming of Apple stock at these prices. Finally, I'll answer the question of whether or not these moves were actually Warren Buffett or the decisions of one of his investment managers. Given that Warren Buffett just put out a Thanksgiving message to Berkshire shareholders saying that he will no longer be writing the annual report or talking endlessly at the annual meetings, and he's also set to retire from CEO at the end of 2025. If it was Buffett, this could have been one of his last moves. After all, in the letter, he said, quote, "I'm going quiet." So given that we have some Warren Buffett news and we don't know how many more of these we'll have left, I'm going to put on my Buffett Munger 24 hat. And with that said, let's roll the intro.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using my stock research platform over at dividenddata.com. If you want to follow along, we have a Black Friday sale going on right now where you can lock in 50% off annual membership. And if the tools help you find just one better stock, then it way more than pays for itself. The link to that Black Friday deal is in the description and pinned comment of the video. So first, I went to our AI analyst on dividenddata.com. I asked what was the latest 13F for Berkshire Hathaway, what were the buys and sells? And it gave a pretty good breakdown. Here you can see that the most significant buy was Alphabet, ticker symbol GOOGL. This is the Class A share for Google stock. This is a new $4.3 billion stake, which makes it the 10th largest position in their public stock portfolio. And that was the only significant buy in the quarter. They reduced their Apple stake by 15%, valuing it now at $60.7 billion. And overall, their top positions remain unchanged, with Apple the number one, with Apple still at number one, followed by American Express, Bank of America, Coca-Cola, and Chevron. All right, so let's get into Google stock. Why was this the newest buy? Well, Google stock has been quite attractive for a while. If you're a viewer of this channel, you know that in early 2025, I was loading up. I bought a ton of Google stock. I wish that I bought even more at the time. But really, I haven't bought any in the past few months, and the position's gone up a ton. But the interesting thing is that Google still doesn't even trade at that high of a valuation. Based on earnings per share over the trailing 12 months, the current PE ratio is 27.2. That's not crazy when you consider this is one of the best big tech companies in the world with an economic moat around large portions of their business, so much so that they were arguably a monopoly and almost had to break up parts of their company. They are one of the leaders in AI and arguably the best positioned in AI. And if you actually just look at any of the fundamentals of the business, the earnings per share growth is fantastic. They just hit all-time highs in the latest quarter. And there's some variability over time based on the ad market because Google, even though it's a tech company, it's really a digital advertising company for the most part. Remember, Google Search is their cash cow core business. But even with that being the case, you also have to remember this is a hardcore tech company with extreme levels of talent that is innovating on the boundaries of technology. But that's not why Berkshire Hathaway is buying it. They are buying it because of the earnings and the valuation. And to dive a little more into that valuation, I went from our stock analysis to AI analyst, and I just typed Google forward PE ratio. And you can do this for any stock. And you can do this for any stock and pretty much any metric. During early 2025, in March, and especially during April and that tariff sell-off, you could have bought Google stock at a forward PE ratio of 16 to 17. You simply are not going to find high quality businesses like that growing at such a high rate at this low of a multiple. And that's why I and many members of our community, and frankly, most people online, were buying Google stock at that time. But here's the thing, the stock's gone up a ton, and it's arguably just around fair value and maybe still slightly undervalued. I certainly wouldn't say it's overvalued. It's currently trading at a 26 forward PE ratio, which is crazy to say considering the stock went up 67% over the past 6 months. But if you're an earnings compounder, then a 26 PE ratio can quickly become nothing. That can become cheap, especially if you're growing in the double digits every year. Here I have the data among Wall Street analysts for future earnings estimates in the coming years. For 2026, they're expecting 5.4%, which in my opinion is on the low end, considering we're expected 31% for the full year 2025. But in 2027, they're expecting 14.6%, 2028, 12.2%, 2029, 16.9%. So what this would mean if you were buying Google stock today, after it's already raced up a ton in price, the forward-looking P ratio based on 2029 earnings would be 16.4. There are many businesses in the market, often far worse than Google, that would be trading at a higher multiple. Expectations are also for double-digit growth in revenue every single year, which is really impressive when this is a company nearly generating $400 billion of revenue. That would be growing to $625 billion of annual revenue. The consensus price target among Wall Street analysts for Google stock is $297.47. That would imply the stock is 7.6% undervalued even at today's price. But this is just some context for you, the individual investor. Warren Buffett and managers at Berkshire Hathaway, they don't really care what analysts have to say. They look to the business themselves. And when you do that, it's pretty impressive on most financial metrics. But there's one potential risk that I talk about when covering Alphabet stock, and I'll get to that in a bit. As you can see, revenue per share for Alphabet stock has grown at a 10-year compound annual growth rate of 19.26%. And we have seen continued growth to new highs in the first 3 quarters of 2025. By the way, if you haven't noticed, I love to look at these data visualizations to really get the trends of what's happening at the actual business. I think when you zoom out like this on a historic time scale and you have all that old data, it really starts to show the picture of whether or not this is a growth business or not and what the trends are at the company. If we take a look at net income per share, you can see the 10-year CAGR is 22.76%. And again, they're hitting new highs so far in fiscal 2025. If we look at free cash flow, this is where we start to get to a little bit more of the negative with the stock. But to determine that, it really depends on your outlook for AI and the data center build out and whether you think the return on investment will be good there. My perspective is it's a prisoner's dilemma where they have to do it in order to retain their position. But there is a very real case where it could be extremely high return on investment. There could also be a risk of overspend. We will see. No one can predict the future. I don't have a crystal ball. But despite earnings and operating cash flow growing at Google, free cash flow has been slow, and that's because of the CapEx spending I was just describing. So the 3-year CAGR is only 5.58%. That's for free cash flow per share. And so far in fiscal 2025, it does not seem like we're on pace to a year of growth. And as I mentioned, that's because of the ramped up CapEx for the AI data centers. In the latest quarter, they spent $23.9 billion in CapEx. That was an 83% increase year over year. And from just 2 years ago, that was a 298% increase. It went from $8 billion a quarter to 23.9. And over the trailing 12 months, Google has spent $77.8 billion in CapEx. And as you can tell, that is ramping up. Based on the latest earnings call, Alphabet revised their CapEx expectations for 2025 to the range of $91 billion to $93 billion. So again, we're still going up. And they gave expectations for 2026 that was, quote, a significant increase in CapEx. And here you can see what analysts are expecting CapEx to grow to. They're expecting $114 billion in 2026 and $127 billion in 2027. These are crazy numbers, but you have to be a great business to be able to fund this. Luckily, Google is. I went and typed in Google operating cash flow so I could get to a visualization. Here you can see the cash from operations for Alphabet stock. The trailing 12 months, they're at $151.4 billion, and they are on a reliable trend of long-term growth here. Alphabet has been a cash cow for a while, and this has allowed them to build up a fortress balance sheet. They have shareholder equity of $386.8 billion, cash and short-term investments of $98.4 billion, which is insane and only really small when you compare it to something like Berkshire Hathaway. They are in a fantastic financial position. They have negative $64.7 billion of net debt. And while they're reinvesting so much into CapEx for their AI data centers, they are also returning capital to shareholders. They are doing share repurchases. As you can see, they reduced shares outstanding by 2% in the latest year. They also started paying a dividend, which is under a 10% payout ratio, and they just did their first dividend increase of 5%. So overall, Google is a fantastic growth business. There's not really any doubt about it. It's just what price you pay. And I certainly liked it a lot better when it was cheap in early 2025, but it's not even ridiculous at current prices. But now let's take a look at what Warren Buffett sold, which is Apple stock. And again, as a reminder, I'm using dividenddata.com. That's my stock research platform. You can get all the tools I showed throughout the video. And right now we have the best deal we ever offer. It's the Black Friday sale. You can lock in 50% off annual membership. There's a 30-day money-back guarantee, so no risk in trying it out. Link in the description and pinned comment below. So let's dive right into Apple. Now, historically, this has been a fantastic growth business, but the story gets a little more fuzzy the more we look into it. One, you can already kind of tell that since 2020, growth has slowed down at Apple. However, when we look at earnings per share, emphasis here on per share, it is still growing. However, a lot of that is due to aggressive, and when I say aggressive, I mean insanely aggressive share repurchases at Apple. Since 2012, they have gone from 26.4 billion shares outstanding all the way down to 15 billion shares. They are repurchasing over $90 billion a year of stock. Now, don't get me wrong, I love returning capital to shareholders as much as the next investor. But when you look at their per share based metrics like earnings per share, you have to take into account that a large amount of the recent growth is from the share repurchases. Revenue per share has grown at a 3-year CAGR of 4.61%. And if we look at the financial statements to see the raw financial metrics, the growth is not impressive. It's gone from $394 billion in fiscal 2022 to $416 billion in fiscal 2025. If we look at the cash flow statement, operating cash flow has gone from $122 billion in fiscal 2022 to $111 billion, so a slight decline. Free cash flow has gone from $111 billion to $98 billion, so again, a slight decline. And unlike Google, Apple's not investing a ton of money in the future of their business. They are spending all of that free cash flow on share repurchases. In fact, their once historically great balance sheet has started to get worse as they've actually added up more debt for these share repurchases. Apple's net debt is positive now at $57.6 billion. Now, don't get me wrong, Apple is still one of the best businesses in the world. I love their products. I have an iPhone. It's awesome. I'm in the Apple ecosystem for the most part. They definitely have an economic moat. It's no doubt one of the best companies in the history of the world. But if you're buying Apple stock today, I don't think it has the growth to justify trading at a 36p ratio based on the trailing 12 months earnings. In what world should Apple stock be trading at a higher valuation than Google right now? I simply do not get it. And when we type in Apple P ratio to the AI analyst, we can go look at the historic P ratio of Apple over time. Warren Buffett was buying the stock at a trailing P ratio of 10, and that was when it was growing faster than it is today. And he pretty much has been trimming the stake ever since the PE was in the mid-30s consistently. A 37p ratio, historically high for the company. On a forward-looking basis, it's a 33p ratio, historically high. And personally, I don't think the growth justifies it. Now, to be completely fair, if we're looking at Apple stock, we may just say that the past 3 to 4 years of slower growth may be behind us. We have had pretty good quarters so far in fiscal 2025, and Q4 2024 was very good. Analysts are expecting higher growth for Apple stock in the future. They're actually expecting higher earnings per share growth for Apple than Alphabet. Explain that one to me. But hey, that's the game of investing, maybe they're right. I certainly think they'll have reliable growth in their services business, but it seems like the iPhone has largely stalled out. It's become a pretty mature business. Maybe they have their next big product hit coming up, and that could certainly juice earnings. Maybe they have the glasses or something. Time will tell. I don't want to be too negative on Apple, though, because it truly is a great business, and I don't really like it being negative about great businesses. My only point here is about valuation, and I think that's why Buffett and Berkshire Hathaway have been trimming it. But was Warren Buffett actually the one making these moves? Well, it's definitely debatable. And the one thing you can say for sure is we don't necessarily know. I'll talk first about the Alphabet purchase. This buy only makes it the 10th largest position in their public stock portfolio. It's really not a huge position in the company by any metric. As an example, Chevron, something that most people don't even know they own and nobody talks about, that position is more than 4 times larger than their Alphabet stake. And their Apple stake, after trimming it many times, is still $56 billion more. So personally, I think it's highly unlikely that Warren Buffett was the one that bought Google stock, especially since he's becoming less and less involved. He's, quote, going dark, as he said in his latest Thanksgiving letter, and he's set to retire at the end of the year, and Warren is also not a tech investor. So I would say it's highly, highly unlikely that Warren Buffett was the one that bought Google stock. But he definitely owns a bunch of it because he's the largest shareholder of Berkshire Hathaway, and they bought it. Instead, this was likely one of his investment managers. They handle a lot of the smaller positions at Berkshire Hathaway, whether it's like Kroger, Visa as an example, or Amazon. And this $4 billion stake is pretty much right in line with these other positions. Visa's 2.7, Amazon's 2.2, MasterCard's 2.1. I would say I'm 99% sure this was one of the investment managers. But what I will say is that trimming the Apple position, that might have been Buffett, because we verifiably know that it was Buffett in the other times that they trimmed. He's talked about it in the Berkshire Hathaway annual meetings. So that's my analysis of whether or not this decision was actually Warren Buffett. And as I wrap this up, I recommend that you read his Thanksgiving letter that he just gave out. It's pretty good, and he talks about the future of Berkshire Hathaway as he's going into retirement, plus how he thinks about the world and his charitable endeavors. I'll put the link in the description and pinned comment. Also there, you'll be able to find our Black Friday deal for dividenddata.com. I recommend you jump on that right away because you can lock in a 50% off discount on annual memberships, and you get access to all the research tools I showed throughout the video. If it helps you find just one better stock, then it way more than pays for itself. With that said, if you enjoyed the video, leave a like, comment, and subscribe, and I'll see you in the next one.